Peter Rose, Longwood Currency Trading, here with my coffee after just talking with an electrician that came by. And there's an analogy between what the electrician and I were talking about and currency price action. I know that's a long stretch, but as a physicist, we look at the process of nature around us as guidelines as to how we can behave correctly, or we should behave within the context of that nature. The nature makes the rules. We don't make the rules. So in currency trading, we think because we have risk-reward ratios and we have stops and we have this and we have that, that we're in control of our currency trading, and we're not. The only thing we really are in control of is our loss. Can't control our gains, can't control which way the price is going to go, and we just can't. It becomes a probabilistic exercise. And in that sense, it's a little different than the electrical work. If I run a wire from here to there, and then I branch off that 18 times, I know probabilistically that the electricity will go fine, equally distributed all those places. But at some point, because of the fragmentation of where that electrical is going and the forces of nature, the rain and the snow and the ice degrading the lines or whatever, animals chewing away on it, one little nick in any one of those branches creates a potentially catastrophic situation. I have a situation now where I have some, I have a situation like that. I have a main line that runs through a box, and out of that box goes a extension cord that goes to a multi-connector that has 3 other extension cords going to them, and then one of those has 2 going from that. It's a spaghetti mess. It was just done to facilitate some very low power lights. The point is, you still have the high power electricity going through there, as you do in your currency trading. You're putting your money on the line. That's your current, right? And if something goes wrong, that current can really do damage to your account. And so the suggestion from the electrician was, get rid of everything and put one main line, one good solid line to go from point A to point B, and then put junction boxes in all along there. So I'm only dealing with one line. I'm still getting the advantage of multiple pull points, but they're all hooked to that one main line instead of coming off of so many different potential problem extension cords. In the currency trading, this is a twofold exercise in learning. It is my long-standing feeling that if you're going to trade, you trade one currency pair. Why would you bother to trade 4 or 5? What advantage do you have in trading 4 or 5? If you can't get 10 pips a day on one, you're not going to get 10 pips a day on 4. The only problem with trading one pair is that you have to trade during the most active time that the 2 countries are online, but you can regulate that. Anywhere you live in the world, you can find 2 or 3 pairs that will perform during your waking hours. Why would you need more than that? Well, what happens if the pair that you have is in a flatline situation? It's just not doing anything. Don't trade. Take a day off. Because if you're trading consistently and consistently making 10, 20 pips a day, when you trade, not every day, you'd be a billionaire in 15 months. Be reasonable about the size of the bank you have and your expectation to gain from that bank. If you're shooting for 200% every 6 months, you're crazy. You know, the best traders in the world run between 20 and 25, 30% a year. Some of them will go 60% a year, and they'll do that for 6, 8, 10 years. Well, how many Beethovens were there? How many Frank Lloyd Wrights? How many Picassos? We're not in that group. if you're watching this video, you're not a Beethoven. I'm not a Beethoven. 20% of the people are going to break even or make a little bit of money. 80% are going to fail. Now, in currency trading, it's 90%, 95% fail, but that's just because so many assholes get involved in it, and they don't have any discipline at all. You know, it's like some dumb shit that's, I don't know, 18 years old, and he thinks he's going to start a multinational car manufacturing company, and he's got, you know, $6,000 to his name. He'll lose that $6,000 just in incorporation fees. So, you know, there's just crazy shit, more crazy shit prevalence in currency trading than there is in real estate investing, for example, because you need $20,000, $30,000 to get involved in real estate investing. Sure, in certain economic periods you could do real estate and no money down and all that other kind of Robert Allen stuff, but for all intents and purposes, you need a lot of money. But you don't need a lot of money to go into currency trade. You start with $100, and you lose $100. So what? So you feed it another 100, and you get hooked. And pretty soon you're a couple of $1,000 out, and then you're out. So that's why the percentage, instead of 80% like most failure rates, it goes to 90 or 95%. 80% of the people are going to fail. You're just going to fail. I'm sorry about that, but if you try to do stuff like I did, learn it on my own, I mean, I lost a huge amount of money when I ran computer simulations against the price action, and I went into the sim market, and I did that. You all know my story. I've done 100 videos. I tell that every time. It's easy to lose your money if you don't know what you're doing. So there's an 80% flush rate, which is parallel with everything else. So if you're going to be successful, be reasonable about the percentage gain that you're going to make on your money. If you have a $10,000 account, you're trading one full, you're not going to make $20,000 a year off that. You know, if you could make 20 or 30%, that's really doable. For the small guys, it's really doable, as long as you're not trying to compound that money. You have to really know what you're doing to compound. If you don't, the reverse compounding goes against you in your losses, and you're going to lose. So if you've got a couple of years of trading, successful trading, then you might want to try to compound. I don't compound progressively. I compound in major jumps. If I have a $10,000 account, and I'll trade that until I make $10,000, and then I will trade two. That's the way I do it. I don't have $10,000 and make $100 and then trade 1.1 lots. I'm just not compounding that way. When you are looking at your job, which trading, you should look at that as a business. You have certain rules and certain expectations that those rules support. And so one currency pair should be the trial for your success or your failure. If you can't use one currency pair and be a success, believe me, by fragmenting your mind and going in a million different directions is only going to dissipate your energy, and you're doomed to fail. Just like the electrician told me, if you keep this system up of all this spaghetti thing of these extension cords and things, yeah, it's going to work. But when it doesn't work, when you get a failure, it will take the whole house down. And that's what happens to your account. All I'm saying is don't fragment your thought process about your trading, because you're doomed to failure on it. Pay attention to the laws that the nature around us provides as to what success is. When the lion goes out on the hunt, he's not going out to kill 42 game. He's going to get one. And he may track that herd for 3 or 4 days until he finds the weakest one. and then he goes after that. Why do you think you're going to sit down at the trading desk, make 14 trades a day, shotgun your way through life, and have any success? Because that's not your survival instinct. That's not our inbred instincts on how we survive. And so we pay attention to how the hunters hunt, because that's what we're doing. We're hunting. We're hunting for money. Be careful about fragmenting your attention and fragmenting your resources. Peter Rose, Longwood Currency Trading. Have a great day, and have a great trading day.